Good afternoon, everybody. It's 3 o'clock in London. We'll be starting in a couple of minutes. If you could just bear with us. Thanks very much. Okay, good afternoon, everybody. Good afternoon to this strange in-person event. My name's Tom Keating. I'm director here at RUSI of our Centre for Financial Crime and Security Studies, and it's my great pleasure to be the chair of today's discussion of the newly published House of Lords Economic Affairs Committee report on central bank digital currencies, which henceforward will be known as CBDCs to save the mouthful for the rest of the afternoon. And the report is entitled Central Bank Digital Currencies, a Solution in Search of a Problem, ? There are hard copies on the table outside, which you are welcome to help yourself to on the way home. And for those of you joining us online, of course, you can find the PDF on the EAC via the EAC website. So I am, as I said, particularly pleased to welcome you all here to RUSI today, because this is the first opportunity we've had from our Financial Crime and Security Studies program to hold an in-person event for 2 years. Can you believe it? We're hosting this event on a hybrid basis. So not only I'm delighted to welcome you all here in the room in London, but also we have a good many people online, 161 as they're still filtering in. So my job today, as well as chairing our panelists, is to make sure that everybody here in the room and online has an opportunity to contribute. So we will take questions from the audience here in person, of course, but do please, in the way we've all become used to, submit your comments and questions via the Q&A box online. And we have the upvote function there, so you can you shut the door? You have the upvote function there if you want a particular question to be addressed. I'm not sure if everyone is familiar with our Financial Crime and Security Studies program here at RUSI, but essentially it makes perfect sense from our perspective for a defense and security think tank to have a program like this, because what we look at is the intersection of finance and security. And I think particularly in this day and age of hostile state activity, as well as everything else that comes with dirty money, money laundering, terrorist financing and the like, this is something that I think it's important to take into consideration. So with that, I just, want to introduce our panelists for today. If I can get my slides to work. I'm delighted to welcome, to start today's proceedings, Lord King of Loughborough, representing the Economic Affairs Committee. He's going to share with us the highlights of the new report for 10 minutes and how the UK should plot its course in the world of CBDCs. I think there are various views and differing views as this concept moves from theory into reality here in the UK. It's obviously interesting to consider the different speeds at which developments are moving around the world in CBDCs, from the sand dollar in the Bahamas. I read last night that the Iranian government has now decided that CBDC is the future. Of course, we expect the concept of CBDC to be on display at the upcoming Beijing Winter Olympics as well. The BIS is hard at work, the ECB is hard at work, and indeed there is a committee looking at this issue between HM Treasury and the Bank of England here in the UK to produce what, of course, the press have dubbed Britcoin, which is a name I hope does not stick. So we will first hear from Lord King in just a moment. I'm then delighted to be joined by two expert discussants, Jason Shepherd of TRSS International and Francis Coppola, who is a financial economist and columnist for CoinDesk, both of whom have extensive experience and views on this topic, as we will hear. Just a reminder, if you are listening online, do please put your questions in the Q&A box. We'll be sure to get to those in the second half of the hour, as well as take questions from you all here in the audience. So let's be thinking about those in advance. So with that, I'm delighted to pass the floor to Lord King. Sir, the floor is yours.
Well, Tom, thank you very much, and good afternoon, everyone, both here in the room and online. I'm very pleased to have this opportunity to present to you, both in the room and online, the main points from the House of Lords Economic Affairs Committee report on central bank digital currencies published 5 days ago. And I'm very grateful to RUSI for organizing this event, and to my two panelists who will be speaking later. I will try to steer clear of the topics that they will want to cover. And also, of course, to my fellow committee members who've come along and no doubt may want to add something later. So should the UK have a central bank digital currency, or CBDC? Well, later this year, the Bank of England Treasury Joint Task Force will submit a report on their provisional views on the merits of a central bank digital currency. And our committee took evidence from a pretty wide range of private and public sector witnesses on this question. So what did we conclude? Well, a natural place to begin with is the title of the report: Central Bank Digital Currencies, a solution in search of a problem, ? So let me start with the subtitle, a solution in search of a problem, ? And the question mark is important because we do not in this report provide a set of recommendations about what should happen. Instead, we pose a number of questions which the Joint Task Force must, in our view, answer before reaching a decision. And by far the most important and wide-ranging of those questions is, what is the problem to which a central bank digital currency is the solution? Now, there are many different and often conflicting views about the nature of the problem to which a CBDC is the answer, and these were presented to the committee in evidence. But none of them were really terribly convincing. So why was this? Well, then let's turn to the main title of the report, Central Bank Digital Currencies. And the first thing to say is that a CBDC is not a currency. If the Bank of England, the Federal Reserve, or the European Central Bank were to issue a digital currency, it would be in sterling, dollars, or euros, respectively. And it's important, therefore, to distinguish between cryptocurrencies, which purport to be new currencies, and CBDCs. The latter are all about payment systems. The vast majority of payments today are transactions conducted through private sector institutions, such as commercial banks and institutions offering debit and credit cards. These are already digital. So the question is, why should the state operate a payment system as opposed to regulating, which it does now, a competitive private sector system? Now, the answer to that question is likely to depend on the degree of financial development of an economy. The UK has a highly developed system of digital payments. I could make a payment to any of you today by a few clicks on my bank internet account with virtually instantaneous transmission of the funds to your account at no cost. I'm not going to do that, but I could if I wanted to. And it's no accident that the early adoption of CBDCs has been in economies which are financially much less well developed. Now, in evidence to our committee, the Bank of England made clear 2 points about a potential CBDC in the UK. First, the bank has, very sensibly, no wish to offer a bank account to every citizen in the UK. The idea that the governor is going to sit in his office answering telephone calls from 65 million clients who can't log on to the account is not going to happen. Instead, a CBDC at the retail level would take the form of a so-called digital wallet backed by the central bank, but operated by private sector institutions. The second major point which the bank made in evidence to us was that there is no need to introduce a CBDC at the wholesale level because the wholesale payment system is continuously being improved and the Bank of England already offers bank accounts to an increasing range of financial institutions, which is why it is able to operate quantitative easing. And commercial banks today hold large deposits with the Bank of England. So we are left with the possibility of retail digital wallets operated by competitive private sector institutions. And in our report, the committee poses 6 questions that need to be answered by the Joint Task Force in respect of a system of retail digital wallets. First, since central banks implicitly guarantee most or all deposit accounts in commercial banks, either through deposit insurance or through regulation or the provision of liquidity insurance to commercial banks in extremis, it's not really clear what's the effective difference between a digital wallet provided by the central bank, but operated by a commercial bank, and a retail deposit account with a commercial bank. And if the concern about the present system is inadequate or insufficient competition, why is it sensible to tackle this problem by creating a state competitor? That's the first question. The second one is that the ability of households to switch their deposits from commercial banks to central bank digital wallets at a time of financial stress would create a serious risk of significant disintermediation of the banking system that might require the Bank of England to step in and provide large-scale support to the commercial banking system. What's to be gained by such disintermediation? It's a question that needs to be answered. Third, it's been suggested that a CBDC would provide, and I quote, additional monetary policy options to a central bank. And the question is, what are these additional options? Some economists have argued that it would make it much easier to impose negative interest rates on household deposit accounts because the Bank of England could eliminate cash completely. But the bank has said that it has absolutely no intention of eliminating cash completely. Fourth question, the CBDC clearly creates a potential single point of failure. Only last Friday, the Eastern Caribbean Central Bank suffered a systems failure which brought down the operation of their entire CBDC. So how serious is the risk from a single point of failure? We don't know that, but we think the question needs to be posed and answered. Fifth, how would the privacy of retail digital wallets be protected? The operators of such wallets would be responsible for meeting current regulatory requirements such as know your customer and money laundering regulations. So how would the bank underwrite digital wallets without access to information that might impinge on customer privacy? The privacy issues need to be answered too. And finally, and sixth, who would be eligible to open a digital wallet in this system? Would it include just UK citizens, or would anyone be eligible? And would there be a limit on the size of such wallets? There are no such restrictions on the holdings of physical cash. Now, again, we don't provide answers to these questions, but we do think these are questions to which the task force needs to be able to respond. There's one further point on which the committee didn't receive evidence that we found completely reassuring. The committee argues that if there were to be a CBDC, then the proposals for it should be put before Parliament and not introduced as a sort of technical measure without legislation. After all, Parliament did vote on the Bank Charter Act in 1844, which imposed restrictions on the note issue of private sector banks. And the Bank of England has actually had a monopoly of the physical note issue since 1921. Now, there's perhaps one last point related to a CBDC, which is the proliferation of cryptocurrencies and stablecoins that we see at present. I stress at the outset that a CBDC is not a currency. There are at least 7,000 or more cryptocurrencies in existence, which purport to be new currencies. And we'll give a prize to anybody who can list 5,000 of them. And there are several stable coins, which are not currencies in their own right, because they are linked to existing fiat currencies. Indeed, you could think of stable coins as the digital equivalent of Scottish and Northern Irish banknotes, except that they're not regulated as such. And in the US, there has been concern about the need to improve consumer protection in the cryptocurrency area and in terms of the backing and legal position of stablecoins. So I think we feel that central banks and governments will need to think through pretty carefully how to regulate these sorts of innovations. And it's far from clear that a CBDC would actually solve any of these problems. Improvements in technology are obviously very exciting, and they have been changing our lives. We don't use the same technology to make transactions today as we did 100 years ago. Payment systems are no exception, and they should become efficient as technology evolves. So it's very sensible for the bank and the Treasury to think about the role of a CBDC in the context of the changing nature of payment systems. We look forward to their report later this year. And in our report, we have set out the questions to which we hope that report will provide answers. At this stage, a CBDC seems to be a solution in search of a problem.
Thank you very much indeed for that summary of the report. As mentioned, I think we'll now turn to our two discussants. And so I'd first pass the floor to Jason, please.
Thank you. As introduced by Tom, my name is Jason Shepherd. I'm here from Thomson Reuters Special Services, where we are exploring the use of commercial financial crime. And I come with a background of about 20 years addressing national security issues inside the British government. And so this being a defence and security think tank, I've been invited to sort of take a look at this from the perspective of potential national security implications. So a bit of a riff on that, if that's okay. At first pass, my take on this is I think the report is rightly quite sceptical in its tone. And I think the subtitle, as you called out, Rob King, is actually quite a useful one at the moment. So I'll take the coward's way out and wonder if we've actually asked the right question. Because it's examining the drivers for investing thought in and planning and execution in a central bank digital currency in the context of the internal systems of the UK at the moment. And I think it poses some very, very sensible questions about what we should do going forward. But the future in which we're moving into is one in which other countries will have implemented the next generation of digitization of their central currencies, and there will continue to be new payment mechanisms, both attached to the central currency, retail Cbdcs, and in the innovative fintech sector that we're seeing coming forward. And I think some of those questions are still worth addressing and keeping in mind. With that thought, one of the most important things that is reflected in the kind of questions that are raised here is that the details of the design of your CBDC really matter. I think that BIS has laid out some of the dimensions of choice quite clearly, actually, in a report last year. And there's about 12 or 24 different options in the phase space, simple choices. You can do this or that, this or that. You can be token-based, wallet-based, so on and so forth. And each of those creates a different set of opportunities and risks, both for the country implementing it and for other countries where it will be deployed. And so I think we need to get ahead of those choices, and we will need to track what others are doing and prepare to implement policies in response to that. And I think that could move very quickly. Whereas I think the report rightly says we've got time to think about this from an implementation perspective in the UK, I'm not sure we have time to think about how to respond to others. So what sort of risks might we be thinking about? So there are a couple of systemic risks that I think could be quite interesting. One of those is just that a lot of the drivers being put forward here for CBDCs are to facilitate payments and to reduce the cost of transactions. We can reduce the overall price that somebody's paying from current electronic systems using Visa and MasterCard and so on. That's great. And in general, consumers like lower friction and financial institutions like lower friction. And we are competing on cost in the wholesale market, and cost and speed for transaction. Those things really matter. But at the same time, greater flexibility and lower friction leads to destabilizing of the system, because once the decision-making cycle in the system gets faster than humans can keep up with, we're depending on having programmed in our safety measures in the computers. Has we ever had a computer not go wrong on them at some point? So there's something around actually the hysteresis in the system and the slowness in the system is sometimes a safety factor. So there's potential risk we'll put in that will emerge there. To tackle that, we need to think about this less from a getting it right perspective and more from an error detection and correction perspective. Can we put in place the protective measures that we would need to identify that something's going wrong and respond to it? Where's our operational force to address the consequences of digital money that would be deployed, thinking from a sort of Russi force perspective, in the event of something going on in that space? I note, for instance, that most of the actors at the moment are reasonably assertive that they are not going to allow their CBDC to be transacted outside of their territorial region and their jurisdiction, given that for many of those countries, the explicit benefit of having one of these currencies is to use it outside. I think, in the EU and in sub-Saharan Africa is pretty much assert. How are we going to respond when that's happening here in the UK? And potentially facilitating all sorts of things. I think there's an interesting risk, if they are implemented, about blurring the distinction between retail and wholesale money, and what makes wholesale money versus retail money. When you look at the very large amounts of wealth in private hands and the transparency that needs to be in place around those transactions to protect us from the potential influence that money has, then CBDCs provide an interesting space in which that could get quite blurred. And you can have opportunities there, but you can also have some quite serious risks depending on the way that you implement it. We get back to the detail again. And finally, just a thought on the risks as part of the conversation that we've been having in our community around the risks associated with retail CBDCs versus potential in wholesale space, where other countries in particular might move to a big step forward in digitization in wholesale space. So the risks in retail are more like public safety risks. They're criminal. There's a lot of money laundering potential there, but there's also the opportunity to police that, depending on the implementation practice that's put in place, design choices you've made. But the risks if the wholesale market goes wrong are existential to the City of London, existential to the effect of the Bank of England, existential to the stability of the UK economy. That's much closer to a national security risk. We don't have a national security community that's attuned to that threat space, nor do we have any way of using that community to inform the levers of response. So that's part, again, of what's the op force that you would have in place to deal with the this new economic environment. One final sort of systemic thought. Will King mentioned stablecoins and cryptocurrencies. And this is an open question, I think, to the community, but the basis for a stablecoin at the moment is that it's pegged to a basket of currencies or other fiat. And so it sort of tracks the market. And in that, if we picture a large company buying a bunch of currency and then offering its own currency backed on that's a bank, right? We should be regulating that appropriately. The other alternative we might see emerging is that they'll offer that backed by their own share price. So in other words, they treat themselves as a central bank and they're going to offer that money backed by their own value. That's a security. And again, we should be looking at regulatory models that are similar. I don't think we have to panic and rush to market. We just have to get the regulatory frameworks right. We need to track what's happening there. So I suppose my concluding point there is I do think we have a choice about whether and how to implement the next generation of digitization of central bank currency in the UK. I hesitate to call it a central bank digital currency. But we don't have a choice in reacting to other actors implementing theirs and the threats and opportunities that that might bring to us.
Jason, thank you very much indeed for those thoughts. Let's move straight on, Francis, to you, please.
Hi, it's a real pleasure to be here and to be asked to speak. I'm Francis Coppola, a financial economist and commentator on matters banking and financial and monetary economics. And I wrote a book a while ago called The Case for People's QE. Oh, and I write for CoinDesk about cryptocurrencies and stuff. I thought I would pick up something that Lord King said, which is to do with the nature of the existing system. And the reason why I think there is misunderstanding about the benefit that a CBDC might create. The days are gone when most people transacted in cash. That has not been the case in most of the Western world now for a good half century. In some countries, notably Scandinavian countries, really they don't use cash at all. Physical cash is declining in the UK, and holdings of it have been increasing during the pandemic, but use of it for payments has been declining. And if you view a CBDC as an extension of your payment system, if you like, a reintroduction of the central bank's produced currency into your payment system, you have to think about why you want to do that. The fact is that most of the money we use for our everyday payments is not produced by central banks, it's produced by banks, and it is backed by central banks. And in that respect, it's not dissimilar to the stable coins that are being produced, because they are also produced by the private sector and backed, perhaps not by agreement so much as just by building up reserves and saying that they are. It's not dissimilar but they are, in effect, or at least in the belief of those who use them, and this is really important, backed by central banks. One of the points I have been making for some years now is that the peg for, say, something like Tether, when you actually look at their reserves, it does not hold in reality, because their reserves are subject to credit and market risk. And so this peg really should really be trading at a discount to the central bank's currency, but they don't, and they don't because people believe that that is a one-for-one peg. In other words, they're taking an option, if you like, that the Fed will always pay out if there's a run. There is no reason for that belief, but it is nonetheless something that people believe. And the reason I think they believe it is that actually in the commercial banking system, that is actually a guaranteed peg. Commercial banks, the exchange of bank money for central bank money, what we know as currency, is guaranteed. Also the exchange of bank money for reserves, which is the money that's used by banks for transfers between themselves, that is also guaranteed at par. And because most retail deposits are covered by insurance, that exchange rate is almost always in effect guaranteed. And that's not the case with things like stablecoins. So if you introduced something like a CBDC, what would you be disintermediating? I am not convinced that you would be disintermediating stablecoins, because I think that the people who use stablecoins actually are not fundamentally interested in fiat payments. They are interested in cryptocurrencies, in using those as a proxy for fiat currencies in the crypto world, and that's what they want to use them for, because fiat currencies generally are not very liquid in the crypto world. So you need something else that you can call, say, a US dollar or a British pound, but that works in the crypto world. And that's pretty much what stablecoins are used for. It has never been clear to me why central banks that were already producing large amounts of digital currency to facilitate payments between banks, and a commercial banking system that is producing large amounts of digital money that is used every day for millions of transactions, why we should suddenly need to upend all of that to create a central bank digital currency, simply as a knee-jerk reaction to a bunch of stablecoins, which are not going to be used for that purpose at all. The report mentions Facebook and Libra and what's now known as Diem, which was a case of a very big retailer, in effect, producing its own currency and the threat that that posed. But I think that the regulatory response to that kind of stopped it in its tracks. And this raises, I think, the whole question about the regulatory framework for the private sector. It doesn't really create a case for a CBDC. It creates an argument for saying we can, if we choose, regulate almost out of existence stablecoins that do seriously threaten the monopoly of central banks. But I think what's really important is that, and for this reason, I really welcome this committee's questioning approach to this, and the balanced and in a way not panicky response to this, is that I think if there was better understanding of how the existing system worked, the imperative to rush into, oh, we need to replace it all, just might be tempered a little. But you could say that the whole direction of travel for the last 50 years has been towards decentralization of money creation, with a central bank backing it. And I'm not entirely clear why we would need to reverse that to create a central bank digital currency which would compete with these decentralized forms of money, with a view to replacing them, and then saying, oh, but wait a minute, we actually need those decentralized forms of money. We want to have banks. And then try and say, impose limits on the amounts of CBDC that people can hold. There was a proposal in the European Union recently, which I think it was for a €3,000 cap. And I thought, there's some people, they wouldn't even be able to receive their wages, which would not make a great deal of sense. If somebody can't pay their taxes because the amount of money they can hold in their CBDC account isn't enough to pay their taxes, then there's not a great deal of point in the CBDC. I also questioned some of the monetary policy arguments as well. I could see, I know there have been arguments that you could use the CBDC to impose negative rates on household deposits. There are serious welfare issues with that, which Bank of England is well aware of, and I think is the reason why it has so far been going, no, thank you. But also, given that our monetary system is largely decentralized, and the banks would respond to that by saying, well, we can offer you higher interest rates. You don't have to have negative interest rates on your deposits. Introducing negative rates on the CBDC, on retail CBDC, I think might result in disintermediation of the central bank. And I'm not entirely sure that's a great idea either. So all in all, I think that there might be arguments for a central bank. I'm quite in favor of helicopter money, and the CBDC would be a way of delivering helicopter money to the private sector. At the moment, the central bank is very reliant on market forces. That is one possibility. A CBDC might also be a way of delivering some aspects of, say something like a universal basic income or something like that. But then we're straying into the realms of fiscal policy, and then we need the government involved in saying, well, how do we want to do monetary and fiscal policy going forward? Do we want to transform all of that? And so I think that we need to think through these other aspects, these wider aspects of the whole way in which our monetary system is constructed and its relationship with our fiscal policy and with our economy more generally, before we go ploughing ahead with the CBDC, simply because, well, there's stablecoins out there and Facebook, and we ought to react to that.
Frances, thank you very much. Thank you all for your thoughts. As mentioned, if you have a question in the room, just raise your your hand if you remember how to do that. There are microphones in the ceiling, so you don't need to be passed a microphone. You can simply ask your question once I call on you. We've got a great many questions from our participants online, so I might just start there. I mean, the discussion, I think we're sort of scratching around for, why might a CBDC make sense? I mean, it's interesting that the countries that seem to be advancing, at least rhetorically and in some cases practically, the concept of a CBDC are very different to the UK. So can we imagine, and I'd perhaps ask each of you to address this, can we imagine scenarios where a CBDC would make sense? So Francis, may I start with you, and to your comment just now, which triggered the thought in my mind.
I think Lord King mentioned earlier that it would depend upon the level of development. The countries that are proceeding, I think, fastest with CBDCs actually tend to be those which don't have a very well developed bank-based monetary and payment system of the kind that I've described. So it's often, I think, I mean, if you look at Mexico, for example, it seems to be driven by the desire to improve financial inclusion and to move people away from physical cash. Now, that's not a bad aim, but it's not a problem in the UK. So really, I think you would need to look at what the particular circumstances of a country are that make them want to move in that direction. The other area that has been doing a lot of work on CBDCs, and particularly wholesale ones actually, is the European Union. And again, I think this is to do with the particular nature of the beast, that, the currency there is not a national currency. It's a currency that's issued by and used by collectively 19 countries. And the CBDC aspect is all part of the development of the payments architecture there, and the move towards seamlessness and free transfer across borders. And so it kind of makes sense for them to be looking at that. But again, that's a very different situation from the situation of a national currency and the national payment system, which is already pretty developed and which pretty much meets the needs of most people. You do have to ask yourself, kind of, cui bono, really.
So, Lord King, maybe if I could turn to you, perhaps take that a bit further. Let's assume that it doesn't appear to make sense for the UK to embrace this, yet the CBDC is being embraced by others around the world. How should the UK be, if you like, getting involved in that evolution? We have a huge financial centre in the form of the City of London. So what should the UK be doing in order to ensure it's part of this evolution, even if it's not something we necessarily adopt here in the UK?
Well, the UK is already involved in the sense that the Bank of England is represented at the BIS. Governors meet every 2 months, either via Zoom now or in Basel, and they discuss all these things. The issue that is genuinely a concern for everyone is cross-border payments. But it's far from obvious that introducing a CBDC oneself actually resolves the issue of cross-border payments. Because, there's no point introducing a cross-border payment and a CBDC arrangement in order to facilitate payments between, say, Britain and France, if it doesn't apply to other countries around the world. And that, I think, is a serious challenge. It will be a digital resolution of it. But if you think about the difficulties of making cross-border payments today, they're all bound up primarily with restrictions on concerns about money laundering, identity of individuals, know your client, politically exposed persons. These are the things that make it not only difficult for banks, but potentially unprofitable for banks to make it easy for individuals to engage in cross-border transactions. Now, central banks understand all this, and there's plenty of scope for them to talk about how to deal with this problem. But I don't think just creating a CBDC resolves that issue, just as Francis said, if you're worried about cryptocurrencies and stablecoins, the answer to that is not to rush away and sort of make your own, as it were, through a CBDC. It's to regulate properly those institutions. And it's very clear that that is what's going to happen in the major economies, the US, has already made that very clear. A bigger issue, I think, and it's a very different one that's unrelated to a CBDC, completely unrelated in a way, is that cross-border transactions at present are essentially mediated through the messaging system in SWIFT. And this is a system which, although it's based in Belgium, it's well known that the US has, a great deal of knowledge about it. And the Chinese and the Russians are thinking about creating a new alternative to SWIFT, which will be immensely attractive to countries like Iran and others who want to conduct transactions outside the purview of the United States. The US is going to have a real problem because there's a limit to how far you can extend extraterritoriality, which they're instinctively inclined to do in every area they're involved in. I saw that very clearly when I was at the bank. And SWIFT works because every country agreed that the messaging system would, everyone would join the system. And it's been pretty successful. But if a rival system grows up, you could easily find yourself in a world in which there are at least two rival systems of making payments. And a CBDC won't at all help or resolve that. And that's really a question of serious international negotiation, really at governmental level, about how we want to be able to make transactions and make payments from my country to your country without worrying too much about who is going to have special knowledge of the individual payments. It's about privacy. If the French president believes, or not the current one, but a French president believes that if he makes a small transaction to his mistress, that the CIA will know all about it, that is not a very sound basis on which to put in place an international payment system. And creating something like SWIFT, which is something that's trusted by countries around the world, depends on, we're moving into a world where it doesn't seem likely that a number of important countries in the world economy will have that degree of trust. And I think that's a major issue that I will be worried about. But I don't think that is going to be solved by a CBDC.
Yeah, I think the report uses this phrase at some stage, the creation of walled gardens, which I think is an interesting way to think about this. Do we end up with these kind of separated financial systems? So, Jason, coming to you, there's a very direct question in the Q&A box, which says, so if the case is so weak for CBDCs, why are so many states developing them or researching their development? What's the answer to that?
Well, I think actually we just heard it, that actually there are some very, very good reasons to develop CBDCs or more digitization of your central bank currency that don't apply here, but do apply in other countries. So there are things like inclusion, there are things like massively opening up the payment system. They don't have a private sector payment competition market in the way that we do here, and they need to start one. They are going to skip forward 2 or 3 generations in technology, largely to catch up with the kind of faster real-time settlement systems that we're used to here. So there's very good reasons to do that. I think the other reason that people will do it, quite apart from those, I think, as Francis laid out, some countries have a different set of, if you like, utility functions for the different qualities of their currency. So we do care about privacy to the degree that we're trading anonymity for actually sort of properly managed identity to enable you to access your assets and have your contracts enforced. We have a particular position on trading that. Others have a different one. There are some countries that bear down enormously on visibility of transactions and are very much less concerned with facilitating private exchange of money. And they would look at this from a different perspective. And then there are those also that would have, I think, as Lord King has laid out, some political reasons to engage in a currency because they want to divest themselves of SWIFT, or because they want to have an ability to transact their currency somewhere else in the world more directly. So you can imagine somebody somewhere moving money around in their local application without having to worry about cross-border transfers. Now, to a large extent, we can already do that with a mobile phone and a Visa card. I can make card holder not present payments anywhere I like from wherever I am. But to be able to hold up my phone and pay Francis some money and for it to be transacted back at home And for the state I'm living in not to know anything about it, that could be quite useful. So there are lots of drivers for doing it that we don't have. So other countries are looking at doing it, and I think it makes sense for them to do so. Hence the observation, we will need to track what they're doing. So this is that a lot of the countries that might share the position that we do will still research the problem and still try and understand it in order to react to the new circumstances that those countries are creating as they digitize their currencies, which means we have to pay attention to this and not assume that everything's fine, which the report doesn't suggest at all. And I think it raises just the kind of questions we should be asking, not only of ourselves, but looking at others as well, to understand how that's going to evolve.
There's a sort of somewhat more granular question from someone who works for one of the big high street banks in the UK here, which says, to you, Lord King, do you have a perspective on the potential implications of a CBDC for credit creation? You sort of touched a little bit on that, but is that something you could expand on?
Well, to the extent that a CBDC would lead to people being worried about disintermediation of the banking system, by which I mean that suddenly people take their money out of bank deposits and switch it to central bank digital wallets, then I think banks would be very nervous that they could face bank runs much more frequently and on a much bigger scale than they have done before, because there is a clear alternative to move the money to. One of the odd things about the run on Northern Rock was that most of the people who bothered to queue up outside the bank branches and take money out left Northern Rock with checks drawn on Northern Rock, which was a very odd thing to do. They might as well have stayed at home and had a claim on Northern Rock without getting cold and wet. But banks would be nervous that the stability of their retail funding deposits would be damaged, and that would have an impact on their willingness to extend credit. And I think that we have to move to a point, I think, at which there's a very clear ex-ante arrangement agreed by all about how commercial banks can go to the Bank of England and draw cash down against collateral that's already been examined by the bank and approved, because that would guarantee the retail deposits in banks. Banks would actually have to have an asset side of the balance sheet appropriate to making that claim, and we would then be in a position in which I think you'd see commercial banks, retail deposits effectively guaranteed by the Bank of England. You could abolish deposit insurance. All deposits would effectively be guaranteed, and we'd have a stable credit creation mechanism, because one of the difficulties of simply allowing money to be created by the central bank and in the form of central bank deposits is who is going to finance the private sector. And the idea that the Bank of England is going to finance the private sector, I don't find terribly attractive. You need a competitive system of banks and bank branches where new entrants can come in, and if they can find attractive investment opportunities to finance that other people have not done so, then the economy will have a better credit creation system. So I think this is a risk, and that is why in many countries looking at a CBDC, they said, oh, we better put a cap on the size of the wallet that you can hold. And as Francis said, this cap looks like being so low that it's not, it's not clear why anyone's going to bother to do it. The people who couldn't because their salaries are too high would all be employees of the central bank. So it's odd to think of what this would actually achieve. It's almost as if people have said, wow, this is a fantastic new idea. I don't really understand what it is, but I've got to be in it. I've got to do it. Here's a new piece of high-tech equipment. I've got to have it. I don't know what it does, but I just know I've got to have it.
Yes. Yeah, Jason, come in, and then we'll come to a question in the audience for the first time in 2 years. So, Jason.
Oh, wow. Okay, well, I'll try and be quick then. A momentous occasion. I think you said something really, really important there, Lord King, around public understanding, and not just on the fact that CBDC, shiny, new is good, must have one, to quote my brother-in-law, but the sense of people queuing outside Northern Rock because they had an instinctive feel there was a problem and they wanted to get their hands on their money, and a check made them feel better. outside of the sort of money classes who think about credit creation from the perspective of leveraged assets and so on, we've had a really, really stable situation for a very long time with one representation of money in a physical form. And we've had a fantastic mental trick that says my bank account is a small box somewhere full of pound notes. Actually, because that shows my age, doesn't it? It's still pound notes, not pound coins. And my mental model of money is still predicated on that. And the idea that a Cbdc wallet in my bank account is different from a credit note in my bank account because it's backed and there's no chance of running on it is completely moot. At the end of the day, I've got a box. Those pound notes are mine and I can go and get them and I can go and spend them. And that's what money is to me. And I think all of these changes that we're seeing and the cryptocurrencies' massive success in engaging the technical community and stablecoins being presented in the way that they are, and this question here is around some people that really understand how money works and how technology can revolutionize the pace of transactions. And the idea of, gosh, of digital runs where I'm going to set up an automatic program to shift money out of my credit account and into my Cbdc account. I mean, that writ large becomes an uncontrollable system. Hence, this sort of speed is not always your friend. Automation is not always your friend in this. But those people will be in one situation, and then the rest of us will be going, do I need a piece of that or not? What's going on? There is an opportunity in the conversation we have around these to learn more about what money actually is, how it actually works, and where we're actually carrying risk as individuals in a way that the vast majority of the population who, you know, in this country, as in many others, own a relatively small proportion of the wealth, think about their money, but then present a risk because of that, because they are open to abuse, they are open to fraud, they are open to being lied to, they're open to having things stolen from them because they're being missold things in the financial sector. And I think that's a really nice example of where this is one of those snake oil things that we need to help people understand better. That's probably part of the systemic protection that we need against some of the risks that these things bring up.
Let's take the question from the room, please. If you could just say who you are and where you're from.
Yes, my name is Shannon Simmons. I'm from DLE Systems. My question really goes back to what we just talked about in terms of, having banks having a secure deposit area. The problem right now is that most institutions already have crypto risk exposure already on their books already, whether they know it or not. If they're not employing any particular type of blockchain technology or analysis to sit there and read it, they don't know what's going out and what's coming in. The risk and the exposure is already there. So what you've just mentioned in terms of just transferring that to the Cbdc, that risk is already existing out there, and we're seeing more and more organisations coming to us asking how can they actually understand that risk. And that's just, is it in Bitcoin? Is it going off to a particular exchange out in Estonia, and they have really bad AML practices, and we know that they're already dealing with illicit funds. So that risk is real, and that risk is already here. All we're doing there is just trying to transfer that risk across to say Cbdc. And I think some of what Jason just said, you partly answered it. We're not actually getting any further in terms of securing the deposit side of it, because that's what a bank is looking for. How does it secure a deposit? How does it continue to make money, fund, lend, build liquidity? This issue here, and what the person I think is asking the question, it's already there. It doesn't change the circumstance of what we're dealing with. We haven't solved that particular problem yet. We're just going to roll it over. Pass back to you.
The CBDC would introduce a new risk, which, as Jason described, would be the very rapid and immediate transfer of deposits from one set of institutions that make loans to the private sector to a central bank that does not. And that is the sort of problem that arose in the Great Depression, when the institutions that were financing, in that case, a lot of small agricultural businesses in the US, simply failed. And these businesses could not easily go to anywhere else. And if you take if the deposits were transferred to the Bank of England, the small businesses are not going to be able to go to the Bank of England and say, look, can I borrow from you? So that's a new risk. And the big challenge for regulators in a central bank or in a separate regulatory body is to look at the balance sheet of a commercial bank and say, what do we think the risks are? And what are we prepared to lend to that bank against their assets in order to help them cope with any sudden loss of deposits? And there's going to be a big haircut applied to a lot of assets. And if the bank says, by the way, we've got all these holdings of Bitcoin, I can promise you the haircut will be very large because it's such a volatile asset backed by nothing. Yeah.
We're coming towards the top of the hour, so I was going to give the panelists sort of an opportunity to say a few last words. Francis, you raised your hand, so please feel free to contribute to that and make any last points. And particularly, I think, what would we want to see coming out of HMT and the Bank of England in the UK? Where should the UK be positioning itself in obviously a conversation that cannot be ignored?
Well, I think where I come from on this is I think the whole thing needs to be de-dramatized. I think the important thing is we see this as see where we are now as Western countries, lots of them are really quite advanced in terms of digitization and to a considerable extent decentralization of their monetary systems. Yes, there are central banks behind it, and RTGS systems are single points of failure, and maybe that's something that needs to be addressed. But there's huge swathes of the world which is not there on that level of digitization, automation, centralization, and pure convenience and protection for the retail sector. And so the most important thing actually is that in a way those countries that are that advanced are there as a resource and a help to those countries that are trying to catch up. And for me, that's way more important than questions about whether we need to be adopting CBDCs. It's what other countries need to be doing so that we can have a more consistent, more coherent, and perhaps more equal monetary system around the world. Thank you for that. Jason, last thoughts from you and thinking forward sort of 12 months.
Yeah, I mean, I think it's a really impressive step to have an institution like this hosting a response like this to a paper like this. It's a meeting of two worlds that I think is important and long overdue. And so I'd really like to see, the community that are interested in protecting UK's national interests and national security leaning in to help inform some of the decisions and some of the tracking of what other countries are doing here and some of the motivation. And I'd like to see some of those who are interested in these policy debates within the financial policy community and the finance sector recognizing and engaging their role in creating and managing national security issues that then impact the rest of the country. I think there's a very powerful relationship between the two, which we need to sort of turbocharge in order to keep up with the world that outside is going to move at its own pace in making decisions and is going to implement new technologies and create some of these new walled gardens, whether we like it or not. So I think there's a lot of potential there, and I think this is a really, really exciting intersection of the two worlds.
Very good, thank you. And Lord King, a final word from yourself.
So the subtitle of the report is A Solution in Search of a Problem. I think what comes out of today's discussion is that there are some genuine problems out there, problems about consumer protection. I mean, the US, for example, has now embarked on efforts to stop celebrities in the US promoting various cryptocurrencies to their social media followers in return for some appropriate compensation as a way of boosting the price of those cryptocurrencies. I regret to say that members of the House of Lords Economic Affairs Committee don't seem to count as celebrities with a large number of followers in that sense. But there are clearly issues about consumer protection which come about through developments in this area. But they're because there are speculative investments that people say, I made a lot of money on this myself last year, you buy it and you can make a lot of money next year. That's got nothing to do with the CBDC. There are serious problems about security, cybersecurity, issues about national security in relationship to payment systems and how money transfers are made around the world. But again, these aren't directly related to having a CBDC. So the problems are clearly there. What we have to avoid, I think, is the idea that, oh gosh, here's something new and exciting. Doesn't it sound fun? Switch on to BBC's technology program and you'll get a sort of incomprehensible description of it. We better have one in the UK. What we need is a much calmer and, as Francis said, a serious debate and discussion about what we think is wrong with our current payment system. How could it be improved? And it will change because of technology. But I think to go away from basing it on a system of competitive institutions which can compete to provide better services would be an opposite direction in which to go. Whereas regulating some of the areas that we've identified problems in, I think is going to be a bigger challenge.
Excellent. Well, thank you all very much. I mean, at one point, actually, we didn't have time to touch on, but I thought was one of the more interesting sessions that actually the committee ran was the discussion you had on privacy and the importance of digital ID and all of that. And of course, there are arguably hurdles one would need to cross, quite big hurdles one would need to cross before a CBDC could perhaps become a reality. Anyway, but putting that to one side, thank you to Lord King, to Francis, thank you so much, and Jason for joining us today. Obviously, this is a topic to watch. I'm sure the committee will keep a beady eye on what's going on that front. Just a quick word as we end. If you want to find out anything more about what we do at our program here at RUSI, do please visit the RUSI website. We've got some other events coming up over the course of February on terrorist financing, on the UK economic crime and international finance landscape. So do please look out for those and join us for those. But thank you again very much, everyone, for coming. Thank you to the RUSI events team for helping us organize everything. My partner in crime, Ardi, who is here as well on this topic. Really appreciate everyone's efforts.